Good morning, everyone. Welcome back. Let's start our discussion where we have stopped in our previous lesson. We have already discussed about the three scenarios in which the new partner joins an existing partnership. Starting with the first scenario, which has further two categories. The first scenario was the new partner purchased directly from the old partners by paying them personally. In this method, we have two approaches to follow, either goodwill method or bonus method. Then the second approach was he can invest directly in the business. Under this, again, we have two scenarios. One is we follow the goodwill method or we follow the bonus method. In the previous discussion, we have already talked about the goodwill, that the goodwill can either go to the old partners or to new partners. I'm revising the rule again because this bonus approach also needs the same rule. Goodwill goes to the old partners if new partner invests more than his share in the new assets of the business. Goodwill goes to the new partner if he invests less than his share in the new assets of the business. Same rule applies if we follow bonus method. The only difference is we do not revalue the business. So the case last is new partner invests in the business and bonus goes to old partners. When the bonus will go to the old partner? When the new partner will invest more than his share. Ree and Boy decide not to revalue the business asset. When this statement is there, we will immediately understand that we do not need to follow the goodwill method. We will follow bonus. Cry invests $50 cash in the business for 1/3. He wants 1/3 percentage, or sorry, 1/3 proportion of the ownership, or you can say 33.33%. Before Cry enters, Ree and Boy both have the capital of 40, and the total capital was 80. Now Cry wants investment. Cry is investing in the business 50. But let's check what is his share, because we need to decide, are we going to give bonus to old partners or to the new one? The total assets after the admission of Cry will be 40 plus 40 from Dree and Boy and 50 from Cry. Altogether, it's going to be 130, the total new assets. Cry wants 1/3 ownership. So if you see, his share is going to be 43.3. He's investing 50. He's investing more than his share. So the bonus goes to all partners. How much more he is investing? He's investing 50, but his share is 43.3, so it comes up 6.7. This is the bonus which we will give to the old partners. When we give the bonus, their capital increases. Okay? We have two old partners, Dree and Boy. So this bonus will be given to both of them. When you divide, you get 3.35. So I'm just writing it 3.3 to make it simple. So we will give this bonus to the old partners. So what will happen because of the new investment? The total new investment is 50. 43.3 is the share of new partner. 3.3 bonus is given to the old partner. Altogether, this is, you will find it 49.99 something, but if you round off, that's 50. After this new investment, the partner's capital, Dree, is going to be 43.3, 40 plus 3.3. Boy is also going to be 43.3 and Cry will be 43.3. They just did it 4 to make it equal to 130. Even if you do this, it will be 129.9, which is 130. Okay, this is extra information that they all are sharing the equal share. So let's record this journal entry. The bonus is given to the old partners. So Cry is investing. If you see, cash is coming for the business. Dree and Boy's capital is increasing because of the bonus. We're not taking out from them, we're giving it to them. And Cry's capital is going to be increased with 43.3. The second possibility is that the bonus goes to the new partner. Same rule, when goodwill goes to the new partner. When the new partner invests less than his share in the new assets of the business, the bonus goes to him. Let's check his share. So in this scenario, he's investing $50 cash and he wants 40% interest in the business. Let's check total assets. They are still 130. If I multiply 130 with 40, this is multiply, with 40%. So his share in the new assets is 52. This is what he wants as capital. But he is investing 50. So he is investing less. So bonus goes to him. How much bonus? $2. From where we will get this bonus? The new partner wants this. So we will take it out from the old partners and we will give it to him. Two old partners are there. We want $2. So it's actually in thousands. So each partner will give, or each partner's capital will reduce with $1. So this is 1. This is not 2. Okay, so he has invested, because this column shows the total of investment. The new partner has invested 50, but he wants a capital. He wants a share of 52. How we will get 52? Because we will take out $1 from the boys and Reese capital. So when we will take out, it will be deducted. So 52 minus 1, it is 50. And after this investment, these are the new capital balances, which is equal to 130, our total assets. Let's check the journal entry for this case. Cry is getting a capital of 52. Here we will credit it. He's bringing cash, so cash will get debit. And Ree and Boy needs to give bonus to the new partner, so their capital balances will decrease with 1. So these are all scenarios for the admission of the new partner. If you remember the rule, the things are easy to understand. So please keep practicing so that you can apply it properly. Let's check the other case which changed the ownership interest. This case is known as dissociation of a partner or partners. A partner or partners can disassociate from the business if because of the death or the retirement. So let's see these scenarios. The retirement or death of a partner from a continuing partnership business result in dissociation and requires a settlement with the retiring partner or with the estate of the deceased partner, the family of the deceased partner. We need to give his money back, his capital back. In the absence of partnership agreement to contrary, the settlement is in according to UPA, Uniform Partnership Act. Usually there is a clause in the partnership agreement that how we're going to do the final settlement for the partners. But if there is no such clause, then we need to follow the general rule of UPA. The discussion in this topic which we will do, that will be according to UPA. Okay, let's check out. The valuation is at the date of dissolution. So, for example, a partner has retired from the business on 1st of April. So we will close the books, not the business, only the books, accounting books, income statement will be closed and the balance sheet will be prepared on the date of dissolution, the date on which he is retiring. So the partnership books are closed as of the date of death or the retirement of the partner. Now, for example, 1st of April, we are closing the books, but we're not in a position to settle the claim of this leaving partner. So might be our settlement will be delayed. And if, for example, the retirement is on 1st of April and we are planning to settle his claim by 30th of June, then there is a time lag, there is a time difference between the settlement. During this time, the partner is not the owner because he left. So his ownership which we need to give him, that will become a liability for the business. And this liability will have interest or increased value when we will finally settle it. How do we make the payment to the partner who is leaving the business? We have 3 possibilities. We can pay him exactly what his capital balance is. For example, his capital balance is 50,000. We will give him 50,000 to settle. We can pay more than his capital. More than his capital means maybe he has 50,000 capital, but we are giving him 60,000. In order to do that, we have different options to apply. We can pay him less than his capital. Maybe because of him, the business is suffering with one of the biggest liability, or you can say law problem. So in that case, the partners might say, we will not give you exactly what you own in the business because of you, we are suffering. So this problem could also happen. As far as discussion of this chapter is concerned, we will not look into the last option. We will only do the first two possibilities. Okay, let's check this. Anne, Mick, and Jess are partners with the capital balances and profit and loss sharing percentages. Anne is 70%, Mick is 50%, and Jess is 80%. And their profit and loss sharing percentages are 40%, 20%, and 40%. These percentage of capitals, they are just for information because it keeps on changing because of withdrawals and additional investments. So don't consider this. Our working is based on profit and loss sharing ratio. Just retires and his partnership's interest is paid out. So let's see how much we are paying him. First scenario in which we pay him exactly what his capital balance is. Can you see the question? His capital balance is 80,000. So his capital will decrease and we will pay him cash. Anne and Mick will continue the business and they will redesign the partnership agreement with the new rules and responsibilities. Moving on towards the second case in which we pay more than the capital of the partner. In our example, the just capital is 80,000 and in this case we are paying him 92,000 as his final settlement. So if his capital is 80,000, we will debit it. We are paying him 90,000, we will credit it, but debit and credit side will not be same. So how do we treat the extra payment? How much extra we are paying him? 12,000. So we have three options to handle this 12,000. We can follow bonus. Bonus to just means bonus is given to just. This 12,000 extra is treated as bonus, and whenever bonus comes, we adjust the capital accounts. So just is getting 12,000 of bonus, whereas Anne and Mick will give him, okay, out of their capital. The second one option is that treat this extra amount as goodwill. Whole 12,000 will be treated as goodwill. We will record it as goodwill on the debit side and the equation will be balanced. The transaction will be balanced. The third option is a revaluation of partnership capital based on fair value implied by the excess. They say revalue the partnership like you was doing in admission. And when you revalue the partnership, how do you do that? They said implied fair value will be calculated based on excess amount. This is the extra amount. On this, we will be calculating the implied fair value. Why? Because we are revaluing, we are calculating goodwill, but goodwill was not because of Jess only. It was because of all the three partners. If this is the share of Jess in the goodwill, the other two partner shares can be calculated based on implied fair value, which we will calculate from this 12,000. We will get the full value of goodwill and then we will also give goodwill to Anne and Mick as well. So let's see all these three conditions one by one. Starting with a bonus to Jess. If you remember, the partnership ownership percentages, the profit and loss sharing percentages was, and percentage was 40. I'm just writing 4 to simplify it. Mick was having a percentage of profit and loss of 20 and Just was having also 40. So it was altogether 100. Bonus is given to Just. So Just is excluded. Whose capital will give bonus to Just? Anne and Mick. Okay, so these two are going to share. So Just's capital will be removed because we are paying him. And cash will get credit with 92,000 because this is what we are paying him. Extra amount which we are paying him, that's 12,000. This is a bonus given to Just by the old partners. Old partners are Anne and Mick. Anne and Mick. So Anne should share 4 and Mick should share 2. Don't say 40% and 20% because 40 and 20 is 80, 60. It's not 100. We cannot say it's a percentage. Now we need to build a ratio. 4 plus 2 is 6. So Anne will share 4 by 6 and Mick will share 2 by 6. Okay. So when you multiply 12,000 with 4 by 6, you get 8. When you multiply 12,000 with 2 by 6, you get 4. So this is how the bonus will be taken out from the capitals of old partner and we will give it to the retiring partner. I hope it is clear. I wrote it clearly over here that make a ratio. Don't take percentage. Let's check the second scenario in which the whole excess is treated as goodwill. So the excess amount was 12,000. We say it's goodwill. So just capital gets debit 80, goodwill gets debit 12, and cash gets credit 92. The third scenario in which we are revaluing the assets based on excess amount. So the revalue is excess, which is 12, divided by who is getting this excess? Just is getting this excess. So divided by his ownership percentage, which is 40%. Oh, sorry, his profit and loss sharing ratio, which is 40%. 12 divided by 40%. So the total revaluation which is needed, that is 30 or 30,000. So this is the amount of goodwill, and it was because of all the old partners. So this 30,000 will increase and capital with 40%. Now you can take 40% because all of them are sharing. So total percentage will be 100. This is percent, sorry. This percentage. Mick will share 20% and Just will share 40%. Of what? Of this goodwill. So 40% multiplied by 30, 20% multiplied by this is percentage, 20% multiplied by 30, and then 40% multiplied by 30 again. So you get 12, 6, and 12. Now in the previous balance sheet, Just capital was 80,000. His capital increased more with 12,000. 80 plus 20 is 80 plus 12 is 92. Now we can pay him. Just capital gets debit and cash gets credit. I hope these three scenarios are clear to you when we make extra payment to the partner. The last discussion of this topic of partnership is limited partnership. We are very well aware of it that the partnership in which one or two partners or more, they have limited liability, but there should be at least one or two partners who share unlimited liability. So let's see its characteristics. Limited partnership must have one or more journal partners with unlimited liability for the partnership debts. Okay, if all are going to be limited, then who is going to bear the ultimate losses? So that's why at least one or two partners should have unlimited liability, and we call them journal partners. There may be any number of limited partner. And if you see, we have three main characteristics of it. Number one, the limited partners are excluded from the participation in the management. We don't let them participate in the management. Their liability for the partnership is limited. Their personal property is not involved. And because such type of things can create a lot of disputes, so it should be very clearly mentioned in the partnership agreement, and partnership agreement should be properly signed and filed. So this is it about our discussion for the partnership. I hope you understand. If you do not understand something, please write in the comment section. Take care everyone. Have a great day.